Gold and silver have entered late last year in our technical assessment an acceleration phase on the upside where the angle of ascent is steeper. And after the congestion zone that we've just seen, and that's what I regard it as, not a top. We had a sharp drop last day of January, and since then you can basically draw a line sideways, and they've been above and below that level. What we're trying to do is define when silver and gold will come out of this congestion zone, up-down zone, and resume the uptrend, because we're convinced, for a variety of reasons, that what's on the other side of this congestion zone is verticality, and very brief verticality, meaning in a matter of several months, we expect to see silver advance to $300 to $500 an ounce.
Gold and silver have moved beyond typical market behavior and entered what Michael calls an acceleration phase, where gains rapidly follow a long buildup of underlying pressure. Michael, a momentum analyst, sees recent sideways moves in gold and silver not as a market top, but as a congestion zone before a major surge. The focus, he says, should be on the deeper monetary trend rather than the short-term volatility. Oliver says gold reflects the long-term degradation of paper money, while silver may now be preparing for the more explosive move. His bold prediction is that once silver breaks out of this range, it could move sharply towards $300 to $500 an ounce, potentially within a matter of months. In this interview, Oliver explains why momentum matters, why silver could beat gold, and why the next phase could surprise investors. Now, we present the clips of Oliver's interview. Before we discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Each of the markets need to be watched now, because the major categories, because they bump into each other. They're causal factors, create positive effects here, negative effects there. Gold and silver have been driving north for a decade. And especially gold. Over time, hundreds of years, gold constantly maintains its buying power, its value. It is a reflection of the degradation of money units. It's not a reflection of global uncertainty, which is a common phrase that the press likes to use and things like that. After all, if we had global uncertainty, such as the onset of the Russia-Ukraine war or the Iran event, gold didn't go up, it went down. So that should dismiss that notion. Its monetary factors are a key underlying wave in most markets. Gold and silver have entered late last year in our technical assessment an acceleration phase on the upside where the angle of ascent is steeper. And after the congestion zone that we've just seen, and that's what I regard it as, not a top. We had a sharp drop last day of January, and since then you can basically draw a line sideways, and they've been above and below that level. What we're trying to do is define when silver and gold will come out of this congestion zone, up-down zone, and resume the uptrend, because we're convinced, for a variety of reasons, that what's on the other side of this congestion zone is verticality, and very brief verticality, meaning in a matter of several months, we expect to see silver advance to $300 to $500 an ounce. It sounds lunatic, I know. At gold, we're not sure where it's going, but it will go up less on a percentage basis than will silver at this point in history. Other markets out there will help generate this acceleration phase in gold and silver, where finally the average Joe on the street, an average analyst, will say, oh, now I understand why they've been going up. It's not global uncertainty. It's not what the Fed's going to do. It's because of this and this. And those thises are, one of them primarily, is the U.S. government, or government debts. We had a crisis in 2007 and 2009. It was predicted by a handful of young guys in the movie The Big Short. Shows that. where they knew there was a mortgage crisis coming. And sure enough, it took a couple of years, but it came. And they were right, and people who laughed at them ceased. Okay. Well, this time we have a different problem. We have a debt problem also in the commercial area and private debt as well, but we have government debt crisis. We know we've had one in Japan. They've had to bring out fire hoses. In fact, the new prime minister who was elected like a year ago, she said, we're going to have to print. Okay, lovely. If the bond market is sick and the stock market turns sick, what's your alternative? Okay. What was the CIO of Morgan Stanley several months ago said the old 60-40 orthodoxy, 60% stocks, 40% bonds, to have a balanced portfolio, quote unquote, is gone. We've got to introduce gold into this. And he was very realistic in that observation. And that's what gold and silver are sitting on, is a tender box of demand. Yes, it will be late. I mean, you could have bought gold a long time ago at much better levels, or silver, which at levels we suggested. But there will be a point here, I think, after we get out of this congestion zone, where the verticality is awesome. And I think a lot of it could occur in 3 or 4 monthly bars, meaning by summer, by the end of summer, where you could have silver at that kind of range, 300 to 500. Now, if you look at a price chart, you say, well, I got to get silver back up to 100, 120 before I believe it, okay? You look at the gold chart and you say, well, I got to get up to 5,500 before I believe it's good again. When we look at momentum factors and this twisting and turning we've had now for 3.5 months, again, draw a line sideways. We're looking for signals from intermediate technical factors, not long-term. Long-term factors are positive, and in fact, the recent drop in no way damaged the long-term momentum trend structure of silver or gold. It wasn't even close to getting to levels that could damage it. So this break was of only intermediate consequence. And now we've spent 3.5 months spooking people both ways, yet to no real effect if you draw a line through the middle. And the question is, when do you know it's turning back up again? Do you wait for it to go back to the highs, or does momentum speak first? Momentum has already spoken in regard to silver. In fact, about a week ago, when it got up over 80, that was enough. We shot up to 88 the other day. It made a statement. It says, okay, I'm ready to go. Silver miners, same story. They crossed some levels the other day that suggest to us, okay, they're ready to go too. Gold is a bit lagged. Now, gold has some key numbers, which we actually traded up to in the dark today, near 4,800. You get back up there again on a daily close, and gold is in our measures is saying, me too, we're going. And I like the fact that silver is leading here and gold is the laggard, because the spread relationship between silver and the mama monetary metal gold has massively disfavored silver for about a decade. Whereas the spread relationship between silver and gold, if you divide an ounce of silver into an ounce of gold and express it as a percent, if you went back to when we were $50 in silver in 1980, that spread was 6.5%, meaning an ounce of silver was worth 6.5% of an ounce of gold. When it hit 50 again in 2011, it was worth 3.1% of the price of gold. Right now, even though price is above those two highs, the spread has now broken out of a clear range that prevailed for the last 10 years. At about 1.4% was the ceiling level. You broke through that late last year. Right now, you're pushing up toward 2%. So we're still dirt cheap on a spread basis, silver versus gold historically. And when we measure the silver miners versus the gold miners, which one's better to be in terms of percent gain? The silver miners already broke out versus gold miners about 2 quarters ago. So what we see within the monetary metals is that the silver component, bullion and the miners, are highly likely to vastly outperform gold's continued bull trend. And I think it could be a very sharp outperformance, a jaw-dropping one. Again, gold might double from here easily. Silver, we're $85 right now. We could see 300 to 500. We argue in the next 3 or 4 months, once we come up out of here. But the momentum metrics argue, yeah, that process is underway. The only one lagging right now is gold, and I would suggest if today's high that we saw intraday, and then drop 2%, drop down from, you get back up there again on a close, gold saying, yeah, me too. In general, we're in a transition, I think, up out of this ink. And you don't have to, you could wait if you want. But again, if you're not already long silver or gold, preferably from levels that we suggested, like for example, the last 3 buy signals we gave in silver based on long-term momentum was at $25 to $26 in March of 2024, $35 in June of 2025, and $56 at last November's close. That's it. We don't give any more long-term buy signals. But still, if you want to be in, there's a lot left here. And, you better consider getting in very soon and not waiting 3 months.
The key point is that Oliver is not just watching the price, he is watching the momentum. He believes momentum often gives signals before the mainstream market fully understands what is happening. He argues silver does not need to rise gradually. After this pause, prices could rise quickly, far faster than most investors expect. He says gold can keep rising, but silver may outperform it in percentage gains. Silver often leads in major precious metals bull markets after confidence shifts. Oliver's message is clear. Ignore today's sideways momentum. The main trend is likely underway, and the breakout could be much stronger than people expect. Now, let's get back to the interview.
They're not totally panicked yet because they're not really smart. They're not really smarter, or they're less smart than most analysts even. And when the price chart breaks down, T-bonds break down, and yields punch out through those multi-year highs on 30-year bonds, and they know what's going on in Japan. So now we have a second major world government that has a government bond crisis. This is not some third world country. We could ignore it. This is not just mortgages, which, here, there, everywhere, little mortgages. This is too massive. This is a nuclear event. And they have very little they can do about it. They can't cut the budget. The Fed can't. The only thing they can do is turn on a fire hose. And they know that. And they, with the central government, will do anything and everything they can do to put out the fire once it commences. And I suspect they'll realize that it has commenced once you take the price of T-bonds and punch through the multi-year lows that we're dancing on right now. That's when they'll suddenly say, well, gosh, I guess we got to do more. And gold and silver know that, meaning the destruction of the money unit in terms of buying power, the increase in the supply, drives them north. And once the public and analysts and portfolio managers realize that, hey, there's no other alternative. Look at the charts. The bonds don't look good. The guy at Morgan Stanley was right. The stock market is rolling over. Oh, my goodness, there's nothing left except chasing gold and silver. And that's why I think you'll get, not just the only reason, there's technical reasons. I think you'll get verticality like we have never seen before. Well, we know he's going to cut more than the other one would have, okay, but it doesn't matter who's in charge there, quote unquote, in charge. They have to respond to this event. It's too huge. They can't sit back and wait. Bernanke waited. Back in 2007, middle of that year when the market was topping out, by the way, in a zone that we predicted it would top out in, Bernanke came out with a statement, said, oh, the mortgage situation is totally under control. He didn't chuckle, but, he almost did. And then a year later, he had the emergency, engage QEs, okay? It wasn't under control. So these guys don't know what they're doing, but they're in charge, okay? So when the events happen, they have to respond to it. They can't simply say, well, we're going to go play golf, okay? They have to do it. And the government will panic as well. But they can't solve it now by cutting the budget. It's too late. Once you get to this point, the crisis, you puncture the balloon. And once that sentiment reality hits investors, gee, it happened in Japan. Oh, it's happening here. Well, what does that mean? It means it probably could happen in Europe or UK, etc. So we have a global government debt crisis, far bigger than any stock markets. In which case it's tabula rasa time. And the monetary metals are quite old. They've not been around like the S&P since the 1950s, et cetera. They've been around thousands of years as money. And the public awareness of that is particularly strong in Asia, and it will come back here again. We're lagged to the reality of that. They'll be ahead of the game over there. I'm not an expert on it, but then again, experts on it aren't always right anyway. So I suspect the Chinese are feeling pretty good, meaning they're not involved in this directly. Yeah, they get oil through the Hormuz, et cetera, but they have other sources as well. But they're sitting in a position where by doing nothing, don't invade this or that, just sit there and be what you are, which historically has been a trading society for thousands of years. You will ascend as the world power. I don't mean military power necessarily, but a strong economy and a stable situation simply by doing nothing. Because there's so much instability elsewhere. Now, we know the Chinese have been accumulating gold massively, and they're preparing for something. Apparently, they understand the nature of fiat currencies, maybe. But they're in a better position than we are to survive the coming economic problem. And also, when we assess the Shanghai Composite Index, which we've done for years, and we've called most of the major moves in it. Recently, it's been advancing like the U.S. stock market. But if you go back and look at 2009 bear lows for Shanghai, when we made bear lows, it's only doubled in a half at current price levels. S&P's up 10, 11-fold. The NASDAQ 100 is up 20-fold since then, largely due to the printing of money. You look at it in a money supply chart in the U.S. and you'll understand, oh, that's why they're up, okay? S&P, in fact, is up almost as much as the growth in the money supply since the year 2000, since the dot-com top. But the Chinese market, while it does have points of vulnerability like we do, technically speaking, is nowhere near bubble status. We're a bubble. When we break, it could be far worse in terms of consequence here, consequence there, and so forth, things people aren't thinking about. The wave effects that affect the average guy, that family, that create pain, that create political uncertainty. Chinese are in a much better position technically. They will likely have a bear market if we have one. After all, we're a world economy, okay? We are connected. But technically, they're not in the same at all. They do not have the vulnerability that we have in terms of the technical downside and likely fundamental downside. So this meeting, I would think Xi is sitting in a pretty good, comfy position in terms of knowing that these events that are going on out there are making China actually look a little more stable. So we shall see. I don't know what's going to come out of the talks, but I don't think Xi is in any panic mode. I think Trump might be. And who knows, China may come in and say, wave a wand and end this thing,
Michaeloliver believes gold and silver are far from finished. He says the market may now be entering the most dramatic stage. The recent pullbacks and the sideways action may have frustrated investors, but Oliver does not see that as a sign of weakness. He sees it as a pause inside a larger uptrend. His focus remains on long-term momentum, and in his view, it still points higher. The key prediction here is about silver. Oliver says silver could reach $300 to $500 an ounce after breaking out. He also says gold could rise strongly, but silver may show bigger percentage gains. This conversation matters for more than price targets. It explains where we are in the cycle, why monetary pressure lifts precious metals, and why silver could soon dominate the market's attention. Share your thought about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel and ring the bell icon. Thanks for watching.